Okay, welcome back. After the last video, here is the very last video of this quarter from my side. And I would like to discuss some more practical issues with you. And first, we'll start with what determines the value of an option. The value of a call option is a function of parameters in the contract, such as the strike price and the time to maturity, capital T minus little t, where capital T is the expiration time and T is the current time. But the value will also depend on properties of the stock of the asset, such as its price, its volatility, and also it depends on the risk-free rate of interest, little r. So in fact, the value of the option, the value of the call option C, depends, as mentioned, on S and T. These are the independent variables, and then on parameters of the asset dynamics, sigma. And then we have a semicolon again, and then we have the parameters of the option, contract K and capital T, and also the risk-free interest rate R. But if we focus on the independent variables, then we just say C, the call option value, is a function of little t and of S. These semicolons here, they separate the different types of variables and parameters. So first the independent variables, then the asset dynamics parameter, then the option parameters, and also the risk-free rate. S and T are independent variables. Sigma is a parameter associated with the asset price. K and T are parameters associated with the particular option contract. And R is connected to the currency, to the risk-free value of putting money on a bank account. And note that the parameter alpha does not appear in the Black-Scholes equation. And so because of the hedging that we are doing, the rate of return of the stock price process under the real world measure does not appear in the Black-Scholes equation. It is a direct result of the hedging argument. Now, what determines the value of the option? Well, first of all, an important aspect is the value of the stock price today, ST, right? So if it's 100 or 10, you can imagine that that plays a big role. Also, the time to expiry, capital T minus little t, that also plays a role because with a long time to expiration, stock can go up or down in much more than with a short time to expiration. And the last aspect is how volatile is the asset. So how much swings, unexpected swings, can we have in a specific period of time? And then there are general principles regarding the pricing, and that is the longer the time to expiry, the more time there is for the asset to rise or fall. So the more expensive the option will be. And the more the asset is volatile, so the higher the sigma, the higher the chance it will rise or fall. So also this means there's a one-to-one relation between the volatility and the price of the option. A highly volatile stock price process gives rise to a highly expensive option and vice versa. Now, how are options traded? And before I show you this, I want to draw a picture. And this is the usual picture that I like. That is, here is the stock price process, and here is the timeline, the time axis. And what I want to tell you is an option is not traded as one option for one stock, for one particular focus that we have so far. No, it is a true market. The option market is a true market. So there are many options available. First of all, there are many possible expiration dates. Capital T1, capital T2, capital T3, capital T4, etc. There are many expiration dates. 1 month from now, 2 months from now, 3 months from now, but also years from now, right? And even 5 years from now. So there are many, many expiration dates at which there are option contracts available. For example, when we are now at January, there is a possibility for the option to expire in January, in February, in March, in May, in September, after 1 year, after 5 years, etc., etc. Every third Friday of the month, the options will expire at the closing time of the option exchange, and that is 5:30. Now, when the stock price now is S0, then also for each expiration date, there are multiple strike prices available. There's a K1. You can have an option that is related to S minus K1 or K1 minus S if we're dealing with puts and calls. A K2, a K3, a K4. And if we are further away, there's many more K1, K2, K3, etc., up to KM possibilities. And for each of these options, there is a quote. So there is a call price related to this for, and a put price related to this for this one, for this one. So it is a true market. There's many time points. So there's many time points. And for each time points, there are many different contracts with many different strike prices available. Now, then, if we look at it more carefully, let's look at this one. This is ABN AMRO. It's a long time ago. We see here that there is a price here. That is the last trade of the stock itself. So basically, we can see that as S0. S0 is like 24.3. And that is what this says. And then we see, for example, this is like January. We are January 2007. So that's a long time ago. And here is, for example, the call for June 2007. And then with strike price 20. So K is equal to 20. And this is the call for June 2007, strike price 25. There's also in October, and in October there's even a strike price of 10, a strike price of 12.5, a strike price of 15, of 17.5, of 20, and of 25, and of 30. And we, next to calls, we also have puts. And we also have many other strike prices and many other expiration dates. Now, if we look at this, let's see if we understand what's going on here. So as I mentioned, here we have our S0, and then we have, for example, a strike of 20. And this is in like 6 months' time. So typically when we look at this, then we say, suppose this is our S. This is the value of the option, and we have a call here. This is the call option. And then we have an S0F at 24.3, and we have a strike of 20. So the strike K is 20 here. So we have an option construction that the payoff looks like this. The payoff looks like this. So with S0 24.3, we see that this option is in the money, deep in the money, deep in the money. So the option is close to the value of the payoff, in fact, right? We have S minus K, that is at this stage 24.3, minus 20 is 4.3. S minus K is 4.3, but there's 6 months to go. And therefore the option is at this time, the bid price is 460 and the let go price, the ask price is 4.65. So there's even 35 cents more in the money. So in the option, so the option value itself, it may be something like it will look a bit like this, right? It will look a bit like this. So this can be understood, right? This can be understood by just looking at the payoff, looking where is S0, where is K, and then see that this is in the money. And S minus K would be 430, And apparently there's 30 cents or 35 cents more in the money. If we look at the second one is a little different. Of course, it has a different strike price. So we will look at a different strike price, and then the strike price would be 25. So that would be here, K is 25. So then our payoff would look like this. For a call, it would look like this. And so this is not yet in the money. Then you could imagine that the value of the option would look something like this. Something like this. And then, of course, it's not yet in the money. With 25, it's not yet in the money. But you see the market says it is between the bid and ask prices of this option are 1.45 and 1.55. So it's not yet in the money, but the market would expect that the price would go up. Yeah, it would go up. So also here, this is something like 1.45, 1.55, maybe the mid price being 1.50. So this is how we can see it. This is how the payoff looks. And this we could in principle compute with the Black-Scholes equation, right? With the Black-Scholes solution. But remember, for the Black-Scholes solution, what do we need? We are now at this point here, and we don't know exactly how the stock is going, but we need a future volatility. And we don't know that future volatility. However, what we do know is a lot of these prices. We know all these option prices, the value of the option now for something that trades in the future. Here or here or here or here or here. And then, in fact, if you think about it, we know put prices, we know call prices, we know TI, we know KI, the strike and the expiration date. We know the interest rate, more or less, that's like 0% nowadays. So we know a lot. The only thing that we don't know, we know S0 also. The only thing that we do not know is the volatility. So we could invert the relation and say, if we have given all these values, moreover, if we have given the option values, what is the sigma, what is the volatility that the market considers based on Black-Scholes dynamics? What is the volatility that the market considers to be for all these option quotes? What is the implied volatility? So we can use all of this information from the option market to try to extract what the market thinks of the volatility of the options. And that helps us to understand the uncertainty of the future. At least it helps us to see what the market thinks about the uncertainty of the future. And this almost concludes my presentation for today, a short one. I wanted to show you, this is a Bloomberg terminal 2009. I want to show you that this is for the S&P 500. The index value itself is like 864. We are here in early February 2009. And then for the expiration of February, you see here we have the call options. Here we have March, the call options. Here we have April, the call options, and May. And here we have the put options for February, the put options for March, and the put options for April and May. And here we have the strike 855, 860, 865, 870, 875. And for a bit longer period even, we have 845, 850 up to 880. And even further away, we have even 825 up to further. So we have a number of strikes. And that is what I mentioned, what I meant with this different strikes in different times to maturity. And with that, we get all these volatilities, and we can in principle use them to see if the Black-Scholes dynamics, if the geometric Brownian motion is a suitable process. So this is just a mathematical model. And we can see whether the market, because we just are dealing with market data, then we can see if the market thinks that this is a good model. It fits extremely well as a building block. It brought the Nobel Prize to Merton and Scholes. So it's a very important building block for modern portfolio theory and for modern option pricing. However, there are discrepancies. Real data appears to have a greater probability of large rises and falls. If we want to model the asset prices more realistically, then we need either to include jumps in our asset price model, or we look for a stochastic process for the volatility itself. And again, that will be computational finance. So the sequel to this series is computational finance, a new master course that we will be teaching at Utrecht University next year. And there you will learn more about more realistic asset price models, the corresponding option price models, and the numerical techniques, the computational numerical techniques that we need in order to get to an option price. For now, I thank you for your attention, and I wish you good luck with the exam. I hope that you tune in the Rabobank presentation, because they are doing these type of things in Rabobank in the quant departments. So with the basis that you have acquired here, you have a good building block to even go and work for a bank. So in that sense, it's interesting if you have the possibility to see what they are doing in the Rabobank. And after that, I wish you good success with the examination. Thank you for your attention.